Hi, my name is Julianne Peterson. I welcome you to Zoom at 8 today. Today is June, what is it, 9th? Is that right?
Yes.
June 9th. So, great. So we welcome you here. Old Capital is a billion-dollar lender out of Dallas, Texas. But I'm here to tell you that there are multifamily opportunities outside of the state of Texas. So I want to greet you tonight. Are you guys working on anything? Is there anything to share? I think, Chris, you have something to share if you'd be open to taking 5 minutes to share what you got going on.
Yeah, you're talking about the Georgia deal.
Yeah.
Yeah. So deal I've been working on for about 8 months, and originally had some other partners on the team that kind of found the deal at first, and then the deal fell apart just because it's kind of a complicated, heavy value add, original owner selling the property. And after working on it for several months, it just fell apart and fell out of contract. And then it was out of contract for, I don't know, 4 or 5 months. And the broker reached out to me and just said, hey, because we had a pretty good line of communication, I think these guys might come back to the table. What do you think about reworking this deal? So I jumped back in and worked really hard on it. And finally, just last weekend, got the purchase and sale agreement signed by both parties. And we negotiated a pretty significant amount down from the original negotiated rate. So I basically kind of took the whole project over. Again, it was out of contract for months, and the broker just had built a relationship with me and felt comfortable and said, hey, I've kind of gone back to them. So it's pretty cool. It's exciting. It was a significant drop in price, and we're pretty excited about the deal. Obviously with COVID and the lending and all that, there's some gray area there, but we feel with the purchase price and some of the other financials I'm lining up that we'll be in pretty good shape. So I fly out on Thursday morning. I'll be there for about a day and a half for the first, I guess I've been out there once before, but this will be kind of gather the financials, a little bit more financials, meet the contractors, solidify the property management company that we've already been in discussions with. And then from there, we'll schedule probably a week or two later, the due diligence and get the contractors on the ground and really dive into the inspections and such. But I've been out there. I've done a ton of work on it. I've probably got 250 hours in this deal. So I feel pretty good about it. It's just a matter of getting the terms right, which we're hoping Julie might be able to help us with.
We're looking forward to that.
Yeah, it's good stuff.
Yeah, that's great. That's been a journey. So we're going to get you on the Old Capital podcast once we close this darn thing. It's been a challenge. I actually love to hear the stories. And I'm hoping to have another guest on when we close his refinance, but I had a conversation with him today. He purchased the property, just a 16-unit deal. In September, October, he got hit with a hurricane. Then he's on a bridge loan, so he's got to get out of it. He's taking 1 or 2 extensions. And now he's got hit with COVID, so he's got to bring in the reserves. I mean, it's like one thing after the other. So these stories are just so helpful for your education and your development. So, Chris, I know you're going to have some. I mean, you already have about a 10-pager right now on that.
Yeah.
So
yeah, I've been writing about it.
Yeah, it's good. I know we have that. Now, David, have you been with us before? Because I know I see you on Slack, but I don't think I've seen you here on Zoom.
I know. So I'm a fellow West Coaster. I'm actually just starting to piece together that you're in the area. So I'm in San Diego.
Me too. I'm in Carlsbad.
Yeah. So oftentimes I'm kind of like up against it, but I popped onto one other. Have seen the recordings, but happy to make this one.
Great. Well, welcome. Glad to have you here.
Thanks for hosting.
Yeah. All right. And Tim's back. Tim, do you have any updates on what you're working on? Tim? All right. Let's go back to David. I kind of cut you off. I didn't mean to do that. What are you working on, David? Anything that we can help you with, or?
Yeah. So I'm just looking. We're looking at a couple of deals. I think right now we're having the most success with, I guess, operators who are already taking on water pre-COVID. So now there's a little bit more motivation out there, just kind of seeing how things line up with June's rent roll, with July's rent roll. But I'm in Lexington, Kentucky. So in a couple of deals out there, love Lexington, looking to expand into Columbus and Cincinnati. But yeah, so right now, just kind of trying to stay in front of everything and be proactive with brokers and piece some deals together, keep the momentum going.
Now, do you have any underneath your belt yet of multifamily?
Yeah, so I'm a GP on a larger deal. It's about 222 units. And then I sponsored my first deal this past December. It was 48 units.
Fabulous.
Yeah, so kind of getting things up and running, and obviously this is so helpful because I see a few of your faces on the Slack channels. I would love to start, kind of commingling and doing some collaboration.
Well, and I say this every week, and I truly mean it, that there is so much power in the Slack channel, whether it's coming to this group or it's going to the Friday group with Briscoe, or it is just talking on a Slack channel, asking questions and inputting, taking that offline and spending time with folks. This is where the deals are done. I know that sounds cliche, but there are so many folks here that either have capital, want to help you with a deal, know somebody who has a deal. This is where it's done. So David, I hope that you can help somebody, who needs. Now, did you have a agency debt on that you sponsor?
The one we sponsored, we went bridge. We were with Northmark Broker Date.
Yep.
We ended up with Conventus out here in California.
Mm-hmm.
But looking to, I would say right around December, refinance into something more permanent.
Great.
Yeah.
Well, we'll take a look at that, David, for you. Get away from Northmark.
Yeah.
Absolutely.
All right, you guys. Anybody else? Hey, Nick, do you have anything that you're working on? I see you're here. Are you with us? Nope, he walked away.
I'm here. Yep.
There you go.
I'm here.
What are you working on?
Let me throw my video on. I just got a workout in.
Okay, let's see it.
Breath. Oh, 3, 2, 1.
There you go.
Guys.
Looking good.
Yeah, I'm working on a couple interesting things. Let me close the door. My 2-year-old is sleeping. So I've been focusing on the Atlanta market, deep in the weeds down there, and I'm working on a 196 unit in South Fulton County, about 10 minutes from the airport. It's in a kind of the last emerging market of Metro Atlanta, and this is 196 units, and it's about 30% occupied. 100 of the units are it's 2 adjacent complexes, and 24 of the units have fire damage, and the sellers want to sell. So stuff that's trading at about 60 to 70,000 a door for Class C value add product. We're hopefully going to get at about 38 to 40. So we're working on that right now. And then up in Gainesville, Georgia, which is an hour, 45 minutes to an hour north of Atlanta off of Lake Lanier, we're working on a 96 unit, Class C plus, B minus. And this is my first kind of taste of distress from coronavirus. So this guy and his brother own 6 or 8 apartment buildings around Atlanta. They probably own, a couple thousand units. And they also, their main business is a textile business, and it got significantly hurt from coronavirus. So they have to sell a few of their assets very quickly to keep that business afloat. So that asset, fair market value in this, pre-COVID is probably like in the 110,000 a door area. And we've got a strike price of about 83,000 a door. So it's, if we can get that done, that would be some pretty good value. 94% occupied, rents are $50 to $100 under market. So some good upside on it too. So those are the couple things that I'm
Nice.
working on.
Now, are you looking for equity capital?
Yeah, we will be looking for equity in both of those deals. Obviously, I have you in mind for debt. I don't know if, with the first deal, 30% occupied. I don't,
Yeah.
that's going to be more towards we're going to have to find a bridge loan or hard money loan to acquire it. But yeah, we'll be looking for equity and debt on that.
So Tim has a question. He wants to know, how did you find the seller? On which one, Tim? I think you can speak now, but he asked a question. How'd you find that seller?
To me, how did I find the seller?
Yeah.
So the first deal, 196 units, that came from a broker, but he's actually part of the ownership, the ownership entity. He's a limited partner in that. So basically what happened there was one of the operating partners, they decided that they wanted to manage it in-house, and that fell through. That partner ended up leaving the entity, leaving the partnership. So they ended up hiring an outside property management firm. And then how did I find the Gainesville property? That came from a broker. Yeah, it's off market. They gave me first look at it, fortunately. And it's gonna be a quick close. The guy wants to close in 60 days, so we're gonna have to get creative with trying to transact on a in a quick manner.
Yeah. Well, bridge lending is opening up, so that might be an option for you on both of those transactions. But, if you're looking for capital and you guys are interested in placing your capital, the time is now to jump on the deal with Nick. And if Chris needs capital, Chris, do you need capital?
Yeah, we're structuring all that stuff right now. We're probably going to end up with about a $2 million raise. And between the partners, we have some, one of the partners is a capital guy, but yeah, we'll probably need a little capital.
So if you guys are at all interested, these are both at, Georgia areas that, pick up the phone, call Chris or Nick. You have to have a relationship with them first so that they can do their documentation for SEC filing to keep it in compliance. So again, this is where the deals get done. Chris, you're going to be talking to him on a regular basis. He's going to be showing up. He's going to show you how it's done. And maybe he can jump on your next deal, or Nick is the same, or David. So yeah, I think it's something to think about. So I thought that I've got a presentation tomorrow to about 125 people. So I'm a little nervous. And so I thought I would present it to you because I think it's information that you guys could use. It's about financing. It's about COVID. It's about some forbearance. I don't want to take too much time in the forbearance, but I thought I would tell you a little bit more about Old Capital if you haven't known Old Capital, as well as what's going on in the market. So let me go ahead and turn on my screen to share. And then we'll get started.
Are we allowed to heckle? I mean, for
Heckle
practice?
is fine, yes. Let's see. Do you see
Pressure.
my screen?
Boo.
Do you guys see my screen?
Yes,
I don't see
Yep.
my screen. Do you guys see it? Okay.
we see it.
But it's not the right screen. This is the right screen. Correct? Did that change? No. Hold
We
on.
see you and Meryl.
Yep, there you go. Now it's big. I don't know if you want to see it big, but there you go. So that's
Cool.
Merrill.
Yeah.
If you guys don't know Merrill, he is an attorney at he is Callister and Associates. So he is a partner with Cindy, who was here. So now I'm on their podcast. So isn't that great? Look at the coffee, the coffee mug. There's Merrill and myself. So anyway. So anyway, I'm Julie Ann Peterson. I'm with Old Capital. We are actually based in Dallas, but I'm here in San Diego. So, and I'm here to tell you that there is multifamily being done outside of the state of Texas. So keep the focus on outside of Texas, but we will certainly do anything we can in Dallas, Houston, San Antonio, some of the tertiary markets. We have very, very good relationships in Texas for sure, but we are moving into other areas. So let's talk about Old Capitol first, and then we'll get started talking about the finance options. So my name, I'm sorry, it's a little bit about me. I have been in real estate for 30 years. I purchased my first home when I was 22. And now I own and manage properties here in San Diego. And I'm also a passive investor on properties in Texas, Kentucky, and a shopping center in North Carolina. As a commercial loan officer for Old Capitol, I work with all types of real estate, but my specialty is multifamily. And I'm also an advisor, as you guys know, on this with Michael Blanc's group. I hold this Zoom call. I also have a meetup in San Diego called the National Apartment Investing Community, which has been kind of shut down for now due to COVID. But, you know, a lot of my clients become good friends because why? Because we like to do business with the people we know, like, and trust. So hoping that we can continue to build a relationship together. And then finally, I am a wife of 24 years. Thank you, God. And a mom of 4 great kids. So Old Capitol, has anybody not heard of the Old Capitol podcast? I'm sure most of you have. We now have 65,000 downloads. These are weekly listeners that come to listen to real live investors who share their successes, their struggles, and their knowledge about multifamily. And this podcast has been known and has been rated the top 5 for excellent, valuable content. So this is our host, Paul Peebles. He is our national underwriter at Old Capitol. And this is Michael Becker, who is the principal at SPI Advisory. These guys, you know, they're dynamos. In fact, Paul is known as the godfather of lending in Texas. So make sure you get that website, www.oldcapitalpodcast.com. Dial it up on iTunes, and you won't be disappointed. There's lots of great content. In addition to educating, we also have a national conference called the Old Capitol Conference. It is held one day in Dallas. We get about 600 to 700 folks, and this is all about education. We're not here to sell you a program. There are no fees. Nothing like that. So the first year we had Rob O'Neill. He was, you know, the from Navy SEAL Team 6, who came and spoke to us about teamwork. And then Roger Staubach, you know, pro Hall of Fame quarterback for the Dallas Cowboys. He joined us and spoke to us about getting in the game. We were actually at the Cowboy Stadium for that one. And then this past year, Lou Holtz, another dynamo, took his colleges to 6 bowls. He spoke to us about taking care of business. And here's this guy, he's 83 years old, talked to us for probably about an hour, 58 minutes, without a teleprompter, without any notes. Amazing guy, had a lot to say. You can look him up on the web, on Google. He's incredible. So at this conference, you'll have an education, just how to do loans, how to get partners. You'll have partners there, passive investors. There'll be deal sponsors, brokers, attorneys, and lots of networking. So this is the conference to go to. Again, it's in October. We don't know what's going to happen this year. But we'll keep you posted on the dates if we go virtual. Not sure where we're at with that. But this conference, when it's live, it is well worth the money. So www.oldcapitalconference.com. Keep that, we'll keep you posted. So today's agenda, I want to go through it. We're going to talk about multifamily loans that are available before COVID, and then now in COVID, what is available, how to qualify for these non-recourse loans, some of the reserve requirements that we're all getting impacted by a forbearance. And then we'll also talk a little bit about the process, so you guys are clear how the time frame works. And here it is. We are ready to open here in San Diego. I was sitting in my car yesterday at an appointment, and I looked up and there's this dog with a face mask. I thought it was so cute. I thought I would share it. All right, so these are the types of loans. There are other types of loans out there, but these are 5 that we take care of at Old Capital. First is recourse loans. I'm sure all of you understand recourse. We're going to go kind of through that. But if you think about what recourse loans are, they're typically banks or credit unions. And it's as if somebody took their hand and took your wallet and said, thank you very much, that's mine. I put that in my pocket, and it's now hijacked until you finish having that loan, doing that loan, processing it, okay? So you do not have access to your balance sheet. We really take, it holds it hostage. So that's the unfortunate part of recourse loans, and we'll go through some of the other details on that. The second kind of loan that we do a lot of business, about 85% of our business is in non-recourse loans. Your Fannie and your Freddie in particular. So these became extremely popular 5 or 6 years ago. The syndication model came about. Banks were, doing loans, at 15 years ago, there was just really a lot of rich people that were buying loans, buying multifamily properties. And up until about 5 or 6 years ago, this model became super popular because there were people that had 50, 100,000 that could be part of this syndication. So this model, Fannie and Freddie took to it, and now it's kind of the place to be to get lending. Another type of lending is a bridge loan. And so a bridge loan is kind of where you would go for if you're repositioning a property where it doesn't have a stable occupancy. You've got a lot of expenses that maybe affect the NOI. So bridge lending is out there. We'll talk a little bit more about that. The other one is your CMBS. Again, we're not going to talk a lot about CMBS, but it's commercial mortgage-backed securities. Similar to a single family group of banks that come together and they sell them off. That's kind of what CMBS is. It's very expensive to get an application. It's about $50,000. This is not for like the application for rehab is not really CMBS. So if you've got a rehab component, CMBS is not it. They start at about $5 million. And then private lenders. And we don't necessarily get too involved with that at Old Capital. Sometimes we'll provide the debt as a private lender. But for this case, there are private lenders out there that will give you loans, 8 to 12, 15%. All right, so that's the overview of those. Now let's look at this. I thought that was really cool. If you look down along this grid, if you look at banks, they are not recourse. They're recourse. They're non-recourse. No. Okay. Very confusing. But so banks are recourse. They're very flexible on the occupancy, where Fannie and Freddie, they want to have 90%. When it's 90% physical occupancy, that is considered a stabilized asset in the eyes of Fannie and Freddie. The minimum loan amount varies from different loans. We'll see on a Fannie, we'll see 750. They really would prefer to do million and over, but that is an option. It gets really expensive when we're talking about loans at 750 because the cost for those is the same as doing a $20 million loan. So it really doesn't make sense, but if you're looking for non-recourse, that is an option. Going to bridge, we really do like to see them at 5 million as opposed to lower. However, I do have 5 million or below $5 million lenders. Hard to get right now, but they're out there. net worth is super important when we're talking about Fannie and Freddie. These can vary on bank loans. Sometimes they require it, sometimes they don't, the net worth. The post-close liquidity, also something that needs to be cash or securities, marketable securities. Nothing that's an IRA would be considered liquidity, okay? So when we talk about Fannie, it's 10% of the loan amount. In Freddie, it's 9 months of debt service. So if you've got a $9,000 loan, times that by 9, $81,000, that's your liquidity that needs to be present in the bank when we're putting these deals together. Okay, max LTVs. Now these have changed. This is, I'm not going to say this is an old set, but we're seeing a lot of changes since COVID. So keep this in mind for previous to COVID. Look at the loan terms. Again, when we're getting into these deals, I'm going to have a conversation with you to say, what is your business plan? How long do you think you're going to have this loan? How long do you need it? Are you going to have it long-term? Is it going to be a legacy asset? Because when we look at a Fannie loan, we have the option of putting a supplemental on. With Freddie, you do not have that. So that's the conversation that we're going to have, because the supplemental allows you to bolt on basically a second mortgage that kicks out your investors, and then it goes coterminous to the end of that, the senior loan. So that's a great strategy, but we have to have those conversations up front. So keep that in mind. Fannie has the supplemental, Freddie does not. The typical loan amounts, 5, 7, 10 for both Fannie and Freddie. Fannie adds a 12-year. On Bridge, you can see it's typically a 3-year interest only. And then you have an option of going to another extension for 1 year and then another extension for another year. The rate will be higher as you add those extensions. The amortization on a bank loan is different. You can see 20 to 25 years as opposed to 30-year amortization. This is the key that always comes in our conversation is experience. I'm working on some deals where people call me up and say, hey, I've got 15,000. I'm looking at a $1.4 million deal. Can I do it? I'm putting 15,000 in. You got to have that extra criteria, which is experience. Okay. So when you're talking about bank lending, and Kevin would tell you that he just had an experience with Union Bank that said, as a bank, he needed to have experience, but typically banks don't necessarily need experience. So you got to kind of check that out. But with Fannie, for sure you need experience. You can on a Freddie get it without experience, but there are guidelines. One of the guidelines is one of your people on your GP are in the area. They live in the area. They have boots on the ground. They're 100 miles from the property. You have a property manager that is a requirement, a third-party property manager that also is required. So you can get around it with Freddie. The thing about Freddie, and it takes it to the last point I have here, is the rehab. You cannot add the rehab into the loan dollars. So if you're on a deal where you have the experienced person, you're going to want to go towards a Fannie loan to do the rehab. The Freddie, you're going to have to capital raise your rehab. Are there any questions on that so far? Is anybody awake? Okay, good. All right, so I want to take you through COVID. Now, what does it look like? Who's participating? So here's the breakdown. When we got into COVID, the government was shutting down banks, companies, employees were being laid off. And so Granny went in, ran to the bank and said, give me my money. I don't feel safe here. And so a lot of banks had to shut down their lending because they didn't have any. But then they got involved with the SBA loans. Okay, that's your PPP, your EIDL. Those are the loans that are helping keep peace with business owners, take care of their employees. So these guys, these bank lenders got bombarded with these loans. So they not only didn't have any funds, they were now being bombarded. I mean, you'd leave a message and no one would call you back for days. So we're starting to see, and it just depends on where you're at, that the banks are starting to lend, but it's, you know, it just depends on the property that you're bringing them. We're finding that banks are really concerned about what the tenant base is. Is it in hospitality? Is it in service? Those are the highest impacted employment that we're having right now, as well as oil and gas. So you go to a bank out in East Texas or Oklahoma, it's going to be hard to find funding out there, whether it's bank or it's Freddie. But I just want to make sure that I'm letting you know, because it's all about collections. It's all about determining what's going on in that area. And banks are really looking at that now. Again, these are 3 to 5 year loans, 20 to 25 amortization, and 70 to 75% LTV. What they are looking at is when people are putting in, and this is also Freddie and Fannie is going to be going towards this route, is that when you have liquidity into the deal, that is, you're saying, I have this for this property, and then somebody's leveraging other properties out there, the banks are going to start looking at the multiple properties that are using that leverage. So be aware of that. If you're working with deal sponsors that have a number of properties that maybe are in forbearance, that is going to critically affect their ability to get you to be able to use their net worth and liquidity. So have those conversations up front. So that's recourse with COVID. The next one is Fannie and Freddie, and they are open for business. They've been open since this started. However, what we did see is that the rates went skyrocketing because they needed to raise the spreads to make sure that there was an insulation in the market. What we saw in 2008 is that it was a crisis, and they didn't know how much it was going to impact them until it was too late. And so they put in effect, who's got their phone? Anybody? There we go. They put into effect some stop gaps. So they raised the spreads. I want to make sure that I'm communicating this very clearly, that on Freddie and Fannie, regardless of now or before, we're going to be looking at experience, even more so now, okay? When we talk about Freddie and Fannie agency loans, we're talking about looking backwards.
This
How
one
did
looks
the
like it's
performance-
bad, actually.
Hey, there we go, Patrick. We look backwards. What happened with the property 3 months, or 1 month, 3 months, 6 months, 12 months? When we talk about bridge lending, we're looking forward. So keep that in mind. We have to make sure that we've got 90% occupancy for 90 days, okay? And once again, you still need net worth and liquidity. 10% on Fannie, 9 months on Freddie. We are trying to understand the economic vacancies. I've done some underwriting on some deals that we're trying to get refinancing on it. And it's tough. We have to understand what the delinquencies are, because as we get further and further into this COVID and the benefit packages for unemployment and the stimulus money people are spending, what is that going to look like? Who's going to be paying the rent? And so it's really helpful for us to understand what kind of tenant base that you've got, so we can put those stop gaps in as well. And then lastly, there was a rate lock that they used to do on Freddie, and it was immediate. Like you'd be able to get it. And this is really on more of the Freddie conventional, but we would rate lock it right away. Now there's a charge for locking it right away. So it's just a couple points, but nonetheless, it's something to consider. All right, so what happened here? Hold on. How do I get that? Okay, there we go. All right, bridge. Non-recourse bridge. There is recourse, but we're going to focus on non-recourse. That's really what you want. Okay, and this is like for rebuilding, as you can see in the picture. Rebuilding the apartment complex, going from C to B, D to C, something like this, okay? These shut down. There was crickets all over the place on bridge lending. It's slowly coming back. I made phone calls to 8 lenders. 4 of them returned my calls because they're not doing it. Again, they're looking forward, as I mentioned. So when you are looking for a bank or for a bridge loan, what we need to know, you need to communicate, again, because we're looking forward, is what your rehab is. What is that going to consist of? What is the dollar amount? We really are looking for $5,000 a door on rehab. Now, you know, it could get up to $10,000 a door, but for the most part, we're targeting $5,000. It's where it makes sense. Are you going to be able to get the rent bumps? Is this rehab going to create rent bumps for you? If so, how do we know? What is the competition? You need to support, you have to give me supporting evidence to say, Julie, I know that we can go from 600 to 1,000 because ABC property has that, or they're at that, and they've done these improvements. So as long as we have that information, we can provide that to our lenders. This is all about, and when we talk about gathering information, that's all about for me to go to the lender to give them all the reasons why they should give you the loan. Okay, so anything you can tell me about the property, it was in a hurricane, they fixed it up, they did a terrible job, I needed to get another $240,000, I rehabbed it, I raised rents, COVID came, I lost my tenants, now I need to refinance. This is the stuff that I need to know, okay? Also, really important, when you're looking for a property manager, not only in bridge loan lending, but also in Fannie and Freddie, is to know that that property manager is managing properties that are exactly like yours, in that they're doing 32 units, they're doing 150 units. They have 5 or 6 or 10 different buildings of that same unit count, the same 1 bedroom, 1 baths. So they know what the mix is. We want to know that they know how to do the rehab. If you don't have rehab, how is that rehab going to get done? So somebody that should be on your team is not only a PM, a property manager, but also a construction manager. If you guys have never met Rich Trepanier, he is on Slack. Reach out to him. He is a contractor. He's super helpful. If you're in a rehab, you're doing a bridge loan, he's a great guy to get on your team. He'll run the project, or he'll advise you if it's out of Texas, out of Austin, San Antonio, Dallas. You could use him as an advisor. Rich Trepanier, check it out. And then, as I mentioned here, there are going to be more bridge lenders coming online in the 3rd quarter. Again, things are going to be changing in August. So we don't know. A lot of people are calling me and asking, hey, these reserves that you're putting in place, are you letting up on those? And I would tell you today, no, they're not letting up on them. We just can't at this point. Again, we don't know what's going to happen in July or August, and that's going to be where the rubber hits the road and we can make some real educated decisions. All right. Is there any other questions on the COVID lending, today's environment? Anybody? All right. You guys are easy. So I want to go back because I know that I've said this 2 or 3 times, but I really want to stress what is qualifies you? What do you need? What do you require on your team? Net worth. Now that can come from 4 people. It can come from 1 person. It can come from you and your deal sponsor. The more people you have on your team, the less money that you make. So you want to find the richest partner. And by that, I mean richest as in knowledge and wealth that can contribute. What I say is you got to find somebody that either has one of these. When you're looking to get into a deal, finding partners that can fill this void is super helpful. I can bring equity to the deal. I can bring my net worth to the deal. That's your value. That's what you're looking for in these syndications. Second is liquidity. We talked about that. Multifamily experience. So let me go a little deeper on that. You're going to need Fannie and Freddie experience. You can't say, I just got a phone call today. I got a 4-unit building and some single family. Can I get a Freddie loan? I said, well, do you live near the asset? No. Do you have a property manager? No. Do you have net worth and liquidity? No, I only have $50,000 that I'm going to put as EMD, but I'm going to get that back. So in essence, this person has no experience, no deal sponsor, no net worth and liquidity. So I have to deliver the bad news is that, it sounds good and everything, but I can't help you. You might be able to do that at a bank, but the conversations that you and I are going to have when you call me, I'm going to ask you, where's your net worth coming from? Where's your liquidity coming from? Who has the experience? And then ultimately, it's the capital. Now, I would tell you in the past, we have looked at 10% coming from the GP, 10% of the loan amount coming from the GP. Now that fluctuates depending on the market, depending on the property, depending on your deal sponsor, really. If that deal sponsor has lots of experience with Fannie and they have a track record, then you might only need to bring in 2%. Just depends. But we like to say 5 to 10%. Let's hear all the details. Let me know who's the players are, and let's have the conversation with the underwriter. Let's get this all out in the open. As I've told you before, Old Capital is all about execution certainty. And that means that we are going to take you from the time we quote it based on the financials that you're providing to the close. We don't want to play around in having to retrade it. Now there are brokers out there, there are lenders out there that'll go direct and say, oh, I can get you 80%. And I'm sitting here scratching my head going, I can only get you 75. We're going by the same guidelines. But ultimately, the borrower doesn't know what the guidelines are. So we are a great resource. We've been through 4 downturns. We know where the skeletons are buried. We know how to get deals done. So, feel free to shop it. But I say this, choose a lane, pick your lane, get on the jockey and ride that through. It's not worth getting to the end. I'm at 4%. The guy's saying, I'm going to give you 80% at 3.75. And then it has to get retraded and you don't close on time. We want to close on time. We want to make you successful and not have to charge, have you go back and get more money. That's not helpful to try and raise more capital to close the deal. So I'm just going to plug that for Old Capital. I'm passionate about it. Can you tell? All right. So let's talk about the reserves because this is causing lots and lots of problems right now. And a lot of the operators that have been doing this for a long, long time are taking their foot off the gas because the reserves are creating an environment where you can't get cash on cash returns to what we saw 6 months ago. All right. So you're going to want to talk to your folks that you're doing, your investors, and find out what their appetite is right now. Are you interested in getting into a deal with me? I'm only going to be able to get you 3 to 5% for the first couple of years, but once my reserves are released, we're going to use that capital for capital improvements, for some rehab, and then I'm going to return to you 8, 9, 10%. Those are the conversations that you need to have because of this reserves. And again, as I mentioned earlier, the reserves are in place now. They are to protect the lenders. They're there to protect the DUS lenders who take on responsibility in case there's a default. We raised the spreads so that there's liquidity in these loans. We reduced the leverage. So if we were at 80%, now we're at 75. Everything went down about 5%. We've raised the DSCR from 1.2 in a standard market to 1.25. So we've raised that to make sure that we are covered, okay? In doing some of this reserves, we've also created forbearance, and we'll go through that. Let me take you through the reserves now, what they look like. And if you called me, we've had the conversation. If you've heard other podcasts, this is what we've been talking about. So this is kind of a breakdown. I'd like to start at Fannie Mae small balance, which is the middle line. If you look at tier 2 on a Fannie below 6 million, you're at 18 months of P&I. That's a lot of money. Okay, so you need to put that in. And I know that our SDAs are looking really tight with those reserves. 12 months of taxes and insurance, and then $300 per door for your replacements reserves. So that's our number one most used product, that product right there. Now this is going to be released after 2 consecutive quarters. Now this may change over the next couple months, but for now, 1.25, again, we've raised the DSCR and we're at 1.25, and that it'll be up for a minimum of 12 months, but then for the 6 months. So if you get into a deal, you've got, it's basically 12 months, it could be a year, but that could change. So we just have to underwrite it conservatively to keep these, reserve considerations. And, you can go down in tiers. You're having to raise more and more capital. As you see here, tier 3, 6 months, that's great. More lower leverage, so there's not much risk. And then even going further into 55%, it doesn't make a lot of sense. It's not really the multifamily strategy to be doing it at such low leverage. But if you're looking for, to dump your capital on a 1031, this is a great option. Looking at the larger conventional, starting at 6.1, it goes down to 12 months. Same deal, 12 months, 6 for the tier 3, and then none on the 55. Okay, so that's all standard. Any questions on that? All right. Assumptions. There are no reserves for the assumption taking over that initial senior loan, but most likely you're going to need to bolt on a supplemental, and then those reserves are added to that supplemental. So, if you're taking out $1 million, you have the P&I 12 months for that. Hope that makes sense. If not, let's talk about it.
Can I ask a question, please?
Sure.
In reference to the assumptions, the slide before,
Yeah.
the supplemental, can you just explain a little more about the supplemental, what it is? Because I'm not exactly for sure about the supplemental.
Sure. Thanks for asking, Daryl. So if we don't talk about a supplemental, we'll just talk about an assumption. Let's just talk about a supplemental. So let's say your business plan is 5 years. You want to hold this for 10 years. In 5 years, you want to exit your investors. So you want to keep it. So you need to find a tool that allows you to release your investors or the percentage of what they've invested, whatever your PPM states. But you can bolt on that supplemental after year 1. So year 2, you can bolt on a second loan that will give you 75% LTV of the new appraised value. Now, at year one or after year one, which is year two, you know, there's not going to be a lot of value. Maybe value creation is by just cap rate compression. And that's, you know, some of our lenders go, oh, that's kind of free money. We have to explain how this value was created, blah, blah, blah. With the supplemental, you are getting money. We're giving you money on that new value, and you could pay off your investors with that supplemental. And then it goes coterminous to the end. Okay, that makes sense, right, Daryl? That all makes sense?
Okay, so if I assume a loan, and I'm under the assumption, I'm assuming that if I assume a loan,
Correct.
and let's say that I have 5 years left on this assumption, are you saying on the 5th year I could take out a supplemental, or I just refi?
No, you can take out a supplemental, you know, based on the appraised value of the property. Let's say you're buying it at, you have to pay off you don't have to pay it off, but you're adding to the first,
Okay.
right? It's $1 million.
Right.
It's valued at $2 million. We're going to give you 75% of the difference for what you owe and what the value is. 75%.
Okay. All right.
You're going to pay them off. You're going to take on the debt, right? And you're going to take on that supplemental, which is going to help towards paying basically the price increase, basically.
Gotcha.
Does
Okay.
that make sense?
Yeah.
Now you could also bolt on a second supplemental. I have to double check that, but I believe that there are actually, let me step back. If that senior loan has a supplemental and you buy it with that supplemental, because maybe they bought it from somebody who had a supplemental, you can bolt on another supplemental. So you have 2 supplementals and the senior loan.
Okay.
Those all go coterminous.
Okay.
Okay,
All right. Thank you.
sure. Any other questions on that? Anything? Oh my goodness. Our time is coming to an end. So let me just go through this and then we'll close up shop. These are the requirements on Freddie. A little bit less. Again, you don't get supplemental. You don't get rehab. So 12 months P&I. Okay, you do have, it's going to be lifted after 90 days or 12 months after your first payment date. So 90 days after it's lifted and you've had that loan, let's say you've had it for 8 months, it gets lifted. You just have to show you got 80% occupancy and that you got 3 months, consecutive months of collections that were in place when you took out the loan. Okay, so that's SBL. That is your Freddie SBL. Unconventional, basically the same, except you don't have the 12 months. You only have 90 days. So you don't have to hold it for 12 months before you get repaid. But you do have to be at 1.4 or greater. Anything that's greater, you get 6 months P&I. If it's less than 1.4, you get 9 months. That doesn't sound right. I think I made a mistake on that. No, that's right. So if it's less than 1.4. No, that's not right. If it's, I wrote that. I got to redo that one. That's not right. So it should be, if it's greater than 1.4, it should be 9 months. No, that's correct. Sorry. I'll take that back. So if you have greater than 1.4, it's 6 months. So that makes sense. That makes sense because you've got more money coming into the deal. So that makes sense. 6 months. Okay. So that's all. If it goes below 60%, you can get, your IO, full term IO. That's right. You don't have to have any reserves on that. So, all right. So forbearance, really don't need to worry about that right now, but it really restricts your evictions. on both Fannie and Freddie. So we won't go through that. This I really think is really important. So you have your PSA, you've got you submit day one, if you will, then you have your third party inspections. That can take another 10 days. The checklist items, which are long, and you need to be very considerate of timing to get those into our lender. Then we underwrite it. The underwriting could be 30 days. They submit the deal for approval, and then we get the approval, which is at like day 55. And then to close, and this is on a Fannie, you're looking at between 55 and 60 days of closing. Now those had extended, but I've been told that we're seeing deals back at about 60 days, 45 to 60 days. Okay. So would you buy now? The rates are great. They're very low. Do you have experience? There's opportunities for acquisition, for assumptions, for refinancing. But know your market. Get a hold of Chris at Yardi. What is the tenant base of the company or the place that you're trying to buy, the business you're trying to buy? Can you raise that capital? As I mentioned, survey your people. Are you okay with the amount that we're going to return in year 1 and 2? I've got somebody I know actually in Dax. Is that his name? Dax, who's out with Michael Blancs. He's not even returning. He's no rent increases for 3 years. So that's his strategy. So we just don't know what's going to happen coming up, August, September. So it is volatile. There are opportunities, but there are going to be more opportunities coming down the pike. Okay. So we've looked at the loans, how to qualify, forbearance, knowing your roadmap, and should you buy now? So here's some of my wisdom. Do business with the people that you know, like, and trust. Time kills all deals. When you get a deal, start running through it. Get me the information. Call your insurance. Check on the taxes. All of that takes time. You've got other people across the nation that are looking at the same deal. Time is of the essence. And remember that lenders are your biggest partner in the deal. We're bringing 75, 80% of the capital. So build your team, build your relationship with your lender. Okay? So are there any questions before we end? Right on time. Anybody?
One quick question, Julie, regarding interest only. So has anything changed with interest only? As far as regarding to the years that you can get interest only?
We did at first, but it's pretty standard on a 10-year that you're getting 3. And again, it just depends on the lender and the area and how much they're lending and how much they like that area and how much, there's so many different factors. With lending, there's options. There's so many options. So I would say pretty standard is 3 for a 10-year. 2
I know when
for
COVID
7.
first hit, they were dropping it down to like 12 months. And I was just wondering if you think it's
terrible. No, it's
up a little.
Yep. Yeah,
cool.
For sure. Any other questions, guys? Was this helpful?
Yeah, I have a quick question for you.
Sure.
You were saying that because we should be having a conversation with our investors that, hey, we're going to return immediate capital to you right after we get the reserves deposited from the bank.
Maybe.
Was that a strategy that you suggested there?
No, I'm saying that, are you willing to, you could use it in returning that capital, those reserves at that time. You could use it for CapEx expenses instead of raising the CapEx in addition to the reserves. That's what we see a lot right now, is that, hey, it's not going to be right at 12 months. I'm going to be able to give you the capital, but it's rather going to be 3 years. And these are the reasons why. We're going to use those reserves in a really good manner. We're going to improve the property. We're going to hold it an additional 2 to 3 years. We're at year 5 or 6 or 7, and then we're getting out. Or we're going to bolt on a supplemental and we're going to the end. It just depends on what your strategy is. We'll need to know that to have that conversation. Like, are you looking for yield maintenance? Is this something that you're holding on? Yield maintenance could be your best option. It's lower rate. And we can go into that at another time when we talk about yield maintenance and all of the other details, but all the things to consider. There's lots of options when it comes to financing. It's like going to a restaurant. We're going to go and buy, are we going to have medium rare? We're going to have rare. We're going to put onions on it, ketchup, you know, what are we doing? So,
Thank
all
you.
right. Well, if you guys don't have any other questions, there's my contact information. If you've not had it, write it down. I really appreciate it letting me share my knowledge with you, what I know about finance and what we do best, which is close loans. So if you guys don't have any other questions, we'll close up. Once again, I sent out the webinar that we had last week. If you didn't see it, a great webinar. The sound is off a little bit, but John Griggs, you know, started in 2003, is now a billionaire, 2.5 billion in his portfolio. So it's possible. He started out like each and every one of you. So that I posted on Facebook, LinkedIn, and Slack. So take a look at it. But I'm here to create value. If you have any questions, let me know. I appreciate your time, guys. Hey,
Thanks, Julie.
before we go, do we want to keep doing this in the summer, or do we want to take a hiatus?
Keep doing it if there's still
Okay.
demand. Tuesday night, yeah.
Keep doing
Okay.
it.
Keep doing it.
Okay, so just
I
so
don't
you
think
guys,
I don't think any deals are going to stop during summertime. I think we're still looking for deals. So
yeah, good suggestion.
Julie,
So
can you share your those slides to your presentation?
I could, but I'll have to do them after tomorrow because
Yep,
I'm
that's fine.
presenting this tomorrow. So, yep.
Perfect.
So
Awesome.
I'll
Thank you.
present that on the Zoom call. And Nick, thank you for inviting me to your podcast. So I hope that was helpful. It was helpful
Oh,
for
it was
me.
awesome.
Yeah. Next week, you guys, Dave Pinson is here from Trinity. So Chris is considering using Dave Pinson. He's a great property manager. He's in like 11 different states. He has opportunities for you to buy from him. He is awesome. So I hope you guys make it a priority to come join us next week, Tuesday at Zoom at 8. All right, that's all I have. You guys have a great week. I'll
Thanks,
see you next Tuesday.
Thanks
Cheers.
so much, Julie.
You
Thank
bet.
you, Julie. Bye.
Thank you, Julie.
You bet.